My name is Ryan Dunston with East Main Street Insurance. As always, we've got my great colleague, Chris Kamara with Cobalt Insurance Agency. We are coming to you live with House Calls, protecting your home, one call, podcast, link, message at a time. However you like to talk to people, feel free to reach out. We'll help you. We are live, it looks like, in all of our socials, YouTube.
I'm checking that now. Yep.
Yeah, YouTube, Facebook. So feel free to chat. There's a little chat feature. If you have any question that you wanted to ask us, we will immediately stop the podcast and answer your question. But we do have some topics we wanted to go over. It has been several weeks since the news got launched. We do have a great excuse. I mean, we've got Christmas, we've got New Year's, we've got all the holidays, we've got helping clients. It's been busy for myself. I know, Chris, if you want to chat on how busy you are.
Yeah, so what's happened consistently over the last 4 years for our agency is people are off during the holidays and they've got free time. And without fail, the last 2 weeks of the year are the busiest for us in the agency. I don't know if that's the same for you, Ryan, but we have been working almost the entire time. I mean, we're off for the 4 days,
right?
The holiday the day after, the holiday the day after. But beyond that, it just keeps going.
Yeah, I would say definitely from Christmas till New Year's, those days were probably the busiest because everyone is off. Everyone is like wanting to get information. They're home. They've got a few days off that they can make sure they get corresponded back. So I think it's just a good time for people to maybe do their checkups too, and maybe get away from having to cook holiday dinner. I don't know, but it's good to know that insurance is on the minds of people even during their holiday gatherings. Absolutely. And it's a hot topic. I mean, everyone's got their family over. They're like, hey, who's your insurance with? I hate my insurance. The rates are going through the roof. So
get Ryan Lundquist's The Appraiser's newsletter each week that goes out. He has mentioned insurance, I think 3 in the last 4 or 2 in the last 3. I know it was mentioned today when it came out that insurance is still going to be a factor in 2026. So it's not just in our circles, it's living all over real estate now.
Yeah.
It's just reinforced. So
that's why it's good to have those partnerships. I think I told you earlier, I met with a realtor today and we shot a quick little 7-minute intro and Q&A, and she's going to use that for her socials. But I think a lot of them are wanting, it's coming up in every transaction, and it's good that there's agents like us that are helping to navigate clients and let them know of who's writing in the space and what coverages mean. And, there's a lot of new homeowners too that are looking to jump into this and have never had to deal with this before. So a lot of things.
Absolutely. So today I got a little bit more time to prep our slide deck. So hopefully it looks a little bit better. Feel free, anyone, to ask your questions or type them in the chat box. Feel free to type any questions in the chat.
Yeah, definitely chat. I know that we're ready to answer. We're at the helm.
Yep. So we'll jump right on in it. And one thing that we want to add, since we're going more, Brian and I are both going more in depth on these topics, we want to make sure that we properly state that this podcast is for information and general knowledge only. If you have a specific circumstance or would like to discuss, you can reach out to Ryan or myself, and we'd be happy to help you as licensed insurance agents. But in general, what we're discussing are examples and not specific to any one person's situation.
Yeah.
And then the next slide is today's.
I do feel official. I think I told you earlier. It just feels like the info we're putting out there, it's definitely being used. So
well, what we're doing, me and you are doing, is we live in this world every single day. And I know you and I talk about it. What are we going to talk about today? And these are timely and relevant things that come up consistently in our conversations with clients. So hopefully it's valuable to more people as it's a common topic that's discussed.
Yep.
I'll let you go with this slide, and then we'll move on.
Coverage A. What is coverage A? Coverage A is your dwelling. That's your house. That's where you come home each night. It's dedicated specifically to rebuilding, replacing your home at the time of loss. And there's multiple perils. We'll probably use that a lot too. That could happen to your home, whether it be a fire, which is, obviously everyone's bringing that up right now because of the FAIR Plan and fire in general in the state of California. But other large perils that I've seen and we've both had claims scenarios with have been wind claims, water claims. So those are all perils. Perils is a type of loss. So the catch.
You had any snow claims this year so far?
Nope, no Snowmageddon claims this year. So that's. I don't even think we got snow. It just hasn't been cold enough.
Yeah, it's been a little weird with that inversion. You guys were warmer than we are here in Rockland. You guys were warmer in Grass Valley for a number of weeks.
Yeah.
The last couple of weekends, though, we did have high wind, lots and lots of wind and some sporadic heavy rain. I had one client here in Rockland call me up and they said they had a leak in their roof, and we talked through it. But that's been the only claim, thankfully, at the moment that we've had in this winter.
I've had a few tree falls through fences, nothing through a house thus far. But yeah, we did have some wind. Those were some pretty powerful storms. So, that's why we take the call. That's why we show up every day, is to help you through navigating the claims situation. So yeah, coverage A, dwelling. That's the reconstruction cost, not the market value. Everyone's like, oh, my house is appraised at, $800,000 or $1 million, and it's a 1,200 square foot house with on top of a hillside, and it's got $1 million view. So, and
the land itself is worth not just that view, but if the home were completely burnt down, you could sell that bare land for significant money. So
exactly. So that's why I think I've always say a lot of times with my client, Redfin or Zillow or all those other things that may say your house is worth something, but that's totally separate from a reconstruction standpoint. And I talked to a few contractors in the area. Chris, I'm sure you do as well, just to always get an updated expansion on what it costs to rebuild, because those prices vary too. I mean, there's a lot of things that go into that.
Yeah, if you got a cookie cutter home, then economy of scale and lower quality finishes, that could be cheaper per square foot. If you're a custom built home someplace, then it could be more expensive. It's definitely going to run a spectrum. And we utilize, I know you do the same, but we utilize the carrier's replacement cost calculator to get to those numbers. And then I'll tell you from my experience lately, those numbers all seem very, very low. So we have a minimum floor that we quote in our insurance agency for what we're going to cover our clients for, just knowing the market in general.
Yeah. Yeah, it's always a good basis point, I would say. Like any good house has a good foundation.
Yep.
Which is weird. I just actually found out, kind of an off subject, but I did find out that concrete right now is pretty expensive because someone has a concrete, style home, masonry, and he was telling me that concrete prices are actually up more, from what they used to be too. The concrete is expensive. So I was kind of surprised to hear that.
Well, in general, right? Everything goes up.
Yeah.
Right. It's materials and labor are very much increased compared to where it was a few years ago. All right, moving to the next slide. Whoops, gotta be here. There we go. So some carriers, and I'll speak to this specifically, some carriers have this automatic inflation guard. It's coined inflation guard, where your coverage your dwelling coverage goes up by a certain percent each year to ensure that you're properly insured at that point in time for rebuild costs. You're insured to value. Many other carriers don't. So if you had your policy quoted, your policy written 4 years ago, and back then fully insuring your home is $400,000 to rebuild, and now here we are 4 years later with labor much increased in cost, materials increased in cost, and the cost to rebuild is $550,000. That's a $150,000 gap that you don't have on your insurance policy. And to nerd out just a little bit, if we took $400,000 divided by $550,000, that's 72%. So you're insured 72% to value. If your policy face says dwelling at 400,000, but the rebuild cost is 550,000. And let me segue real quick. Ryan and I do not have the license associated with a claims adjuster or an appraiser, right? So we're giving you the best knowledge we can. The person that's going to make the determination on rebuild costs isn't going to be Ryan or myself. It's going to be an appraiser or a claims adjuster, right, Ryan? I think it's
at the time of loss. Yep.
At the time of loss. So if you are insured at 400,000, the claims adjuster or whoever that person is says rebuild cost is 550,000, and you're at 72% to value, that's going to cause issues for you at the time of claim. And we'll go over that in a couple more slides, but just pointing out the very big discrepancy. If your policy is old, you may want to look at it again and readjust or reassure yourself that you're insured to value.
And what I love about this slide is that it says 4 years. You know, a lot of clients that we talk to, it's 10, 15, 30. So they've had let their policy literally set it and forget it for 20 at least plus years. And normally that inflation guard is 2%. I would say, you know, from what I've seen carriers, that's kind of a standard is 2% inflation increase. So, you know, multiply that by that set and forget it. That's got to be monstrous as far as what it would be to replace. So you should always, I think now we are in the time of each and every year is having that sit down with your agent, finding out what the new maybe rebuild costs are in this policy period. And the set it and forget it, I think should be never used ever again.
So moving to that next slide.
Okay.
Here's how you can help with some of this. And that's going to be the thing called extended replacement costs, or ERC. And I'm thankful to see, even for my competitors, the great majority of insurance policies that I review all have ERC on them.
Oh yeah.
It is a low cost additional coverage that is like I said, on almost every single quote or policy that I see, it's on there. I'll read the slide off. So the extended replacement cost is a powerful endorsement providing a buffer, and majority I see are 25 or 50%. I don't know if there's some that go higher, but that's usually what I see. And the purpose, this is the important part about it. The purpose is to help rebuild if costs surge unexpectedly. And the example I like to use, which is not exactly accurate, but it's an easy to understand example, is if a single home, your home in a neighborhood, let's say a subdivision or an urban area, burns down, there's not going to be a million different places pulling vendors. So like if a whole street burns down, right, then there's going to be many, many homes that need to be rebuilt. And that means supply and demand. There's going to be increased prices, demand surge. There's going to be increased prices for labor and for materials. That's what the extended replacement cost is for. If it's just one house, I don't know that it's necessarily going to meet that criteria. Again, this may not be a perfect example, but it is an easy to understand example.
Yep.
Could you add to that, Ryan?
Yeah, I would say it's only for replacement of your home. If you're going to cash out, as they say, and or well, I think if you go and purchase somewhere else, you know, I guess it is carrier dependent, and that's something you want to check to your policy about and talk to your agent, because some of them have that discrepancy. But definitely on a cash out function, if you're going to cash out, you don't get to also use the extended replacement cost. You then revert back to the dwelling limit, and then that's where the cash ACV or actual cash value determination is pointed at.
And by cash out, you mean home burns down, you decide you're done with that property, you're not rebuilding on that property, you're going to take your money and you're going to purchase something somewhere.
You're going to go live on a cruise for 15 years.
It's possible. All right, so now we want to address why this cheat code doesn't work in the myth. So I get this all the time. We get this in competing quotes, and we definitely want to address it. Why don't I just keep my base coverage A lower, let's say at 400,000 versus 500,000, to save money on premiums and rely on that extra 50% ERC or extended replacement cost to cover the difference? And I get it a lot, absolutely a lot in the conversation. And what I would, before we even get to the reality part of it, I would challenge anyone to use some logic here. Why would a carrier charge you a small amount for the endorsement of extended replacement costs versus charging you more for the coverage A to be properly insured? Why would that make sense to save money in that manner if the coverages are going to be the same? Then everyone would be covering coverage A at lower numbers and then getting the endorsement for ERC and saving a bunch of money in their premiums. The logic doesn't pencil out. If you just think about how that plays out, it doesn't make sense, right? You get what I'm saying, Ryan?
Yeah, no, I totally do. And I think the another reason is because the other coverages on top of the dwelling, the coverage B, the coverage C, your personal property, your loss of use, those are all percentages tied to what your dwelling limit is. Mm-hmm. So now you're factoring a lot of other different moving parts.
And right now with the extended replacement costs, we're talking about a total loss. So let's say it wasn't a total loss. Let's say, I've had one 2-story house flood that was like $250,000 in damages, a pipe burst or something. If you're insured to 300,000, you're close, right? ERC wouldn't cover that. Does that make sense?
True. Yeah, because it also has to be at least over 80% then too for the ERC to kick in.
I believe so. I'd have to go and vet that, but I believe that's right.
Yeah.
And then the reality is really, this is the why mechanism behind it, is most insurance contracts require you to be insured to value, or else that endorsement doesn't even apply. Something to think about. It's, again, the why would it make sense to get the same amount of coverage using an endorsement versus covering it properly with coverage A amounts that make sense.
Right.
And then moving on to the risks of underinsuring. So this all ties together.
Only 3, huh?
Well, these are the 3 main ones. Loss of access, right? So I just went over this. You could completely lose access to the extended replacement cost buffer if you're not insuring to value, and there's verbiage in your insurance policy that says if you don't insure to value, then this endorsement doesn't
get it. Yep.
And then the other one is the co-insurance penalty. So this applies to a great many, and not all carriers, but you check it. If you insure the home for less than 80% of of value, then there's something called the co-insurance penalty. In the example earlier, I'll go back to the example 400 and 550. Let me drag this over, and it does not show up. So let me see how I make this show up. 1 second here. We'll share the entire screen there. Okay, so in this example, if you're insured at 400,000 and the rebuild costs 550,000, you're only at 72% to value.
Wow,
so divided by 550, right? So if you're only insured for 72% to value, let's assume worst case scenario. Now you've lost your extended replacement costs. You are now not insured enough to avoid the co-insurance penalty. So you're getting hit with 2 whammies, right? So now let's say, and I'm going to dumb this down just a little bit. Let's say you were supposed to insure for $1 million and you only insured for 720,000. That's 72%. The co-insurance penalty would be if the claim was $100,000, instead of covering the $100,000, and I'm oversimplifying this, we can go into this deeper, but that $100,000 the carrier says, no, we're going to apply the co-insurance penalty. We're only going to pay out 72%, so $72,000. You're on the hook for an additional $28,000. Does
Wow.
that make sense?
Yeah. That's a horrible deal.
Mm-hmm. To save a couple of bucks, right? I mean, we all know insurance is expensive. I'm not getting around that or trying to avoid that. But we're paying at the end of the day, me, you, everybody, we're paying for our insurance. The reason we spend this money each year is for peace of mind that insurance will be there when we need it.
Yep.
Buying the cheapest thing almost always does not work out to being the best option or the best choice.
And that's really kind of tying in why a lot of people are complaining whenever it comes down to not getting paid out the right amount, is because it wasn't insured for the right amount.
Absolutely. So yeah, bottom line, if anyone ever tells you the extended replacement cost makes up the difference and you're going to be okay, I'm not saying they're wrong, but I would say question it, get it in writing, right?
Yep.
That's what you want. You want it in writing, not just somebody going, trust me, I'm a great guy. Get it in writing. And then I think that was, wow, we're 23 minutes in already. That's pretty quick. This is the last slide I have in the deck. So anything else you want to touch or go over?
That was really great, Chris. You're amazing with the slides. You're amazing with building content.
Time today, so.
No, I mean, I didn't see if there's anything that came in. No one had a question, no comments, no concerns. Other than our new carriers that are out there, I mean, we're definitely seeing movement in the market. I would say there's 2 or 3 new companies that are coming out, trying to right in the area. Farmers made that huge announcement back in, I want to say November, like towards the end of November, beginning of December.
Yep.
How they were committed to being able to write into new areas.
Have you come up against any of that? Because we did one, and I'm not bagging on any one carrier, but we did one, and they've come back in, but their rates are right in line, if not a little more expensive than our other carriers. So we're talking parity here.
Yeah.
It's like someone's coming in and going, oh yeah, we're gonna be cheaper by 20% of everybody else. I have not seen anything like that.
I don't think that that's going to happen until 27, 28. I mean, we need at least 2 handfuls of carriers. That's 10 carriers at least to be in the market to help create that competition. And right now we're barely getting 2 or 3. So they know what the rates are. That's the thing. These companies know what the rates are. They see everyone else's filings. They're going to come back in at the exact same rate. The only thing that you really need to be looking at is coverages, whether it be this extended dwelling coverage, other endorsements applicable, like maybe animal liability or swimming pool liability,
solar coverage,
or even it being admitted or non-admitted. There's the financial solvencies of these companies. Or what is it? The auto. I mean, some of the companies are saying if your auto is even with that same agent, then you get discounts. So
absolutely. Yep.
Got a piece. There's a lot of moving pieces you got to kind of put together.
So let me segue a couple of things, if you don't mind.
Of course.
Close out of this.
Oh, it's so beautiful. Love
this guy is an amazing artist. This is Forest Hill Bridge.
Yeah.
And when that fog was here, this is $1 million shot in my opinion. But you never see Forest Hill Bridge like this. It's gorgeous. I did come across this, and I'm not trying to segue too much into real estate, but it definitely shows growth and I would say inflation as well. But this is coming from realtor.com. And if you look, I moved to California in 2000. I wish I had bought a home in 2000 when it was 146. And this is probably countrywide, not just California. But according to realtor.com, you could see the increases from 2010 to 2025 of the median home going from 146 to 420. And then 2020, we saw that spike from 300 to almost 300 to 420,000. So definitely shows growth in inflation. And again, I'm not speaking directly to homes. I'm just saying this is one sign and example. And then on the other subject that was in my brain was, like I said, Ryan Lundquist. I'm going to butcher his name. I'm sorry. Lundquist, I think. His newsletter today or yesterday, he's really engaging. I like his stuff. Very, very insightful stuff. But the part that's relevant to us is right here. It says insurance will still be a big problem. Insurance in outlying areas have been really expensive, but it's becoming problematic in the suburbs too, with rising rates and owners being dropped from policy sometimes. Fair plan policies increase in 2025. And I'll tell you from the realtors I do talk to, this is a factor in deciding whether or not someone does move out to the foothills, to, El Dorado, to Auburn, et cetera.
Yeah. Well, I mean, I talked to a client today that moved up here from the Bay Area, and actually it wasn't up here, it was Auburn. And, his prices, whenever he started several years ago, was $1,400, and now it's $3,000, almost $4,000, $3,500, something like that. So, yep. It definitely changes your total picture of your mortgage payment, because all that's usually included. I just thought about, to totally segue out of all that, was those new reforms that were launched this year. The Wildfire Safety Safe Homes Act.
Those were there. I think we talked about it before we went on break. I haven't heard any new developments. I think the biggest one that a lot of us talk about is the fund to help people replace or harden their homes. I think it was AB 888.
Yep. The Zone Zero.
The California Safe Homes Grant Program.
Yeah.
And I know it's in effect, but I don't know whether or not they actually funded it. So this just says it's been enacted, but I don't think there's a fund that was created or been funded to actually help people yet. And I don't think there's been any new news in regards to that.
Yeah, is it just like you spend your own money and then you get to file that on your taxes, which it sounds like it might be?
No, I think
it's part of the department. Right. Look at January 1st, 2027. About all the way down on the paragraph.
Okay. No, that has to do with reporting.
Yeah, I think what it is you would file it on, you'd pay for it yourself, you file it on your taxes, and then starting next year, you get to.
No, I think that's different. We're talking two different things. This one's a fund that actually funds, it's not a credit on your taxes.
It's going to send you a check if you're doing Zone Zero stuff.
There's funds available right there. I know it's a little small, but my understanding of this program is they're going to fund it. Like it's paying to help with it, not provide you a tax break.
Wow.
Specifically to AB 888.
So it said that it's going to build a department.
It says the bill would establish the sustainable insurance account within
the bill would require the department to collect specified information about the performance in the program on or before January 1st and every 2 years thereafter. So they're probably, it started this year, and then they're going to be collecting things, and then it's probably disbursements going out in January next year.
Maybe, yeah. I mean, I'm just spitballing. I don't know.
Yeah.
Don't know. So
that launched. The Wildfire Public Model Act launched. Insurance and Wildfire Safety Act, AB 1 launched. The Eliminate the List launched.
That was a good thing. I think that after having discussion around that, I think that was a great thing.
Yeah. Business insurance protection, basically like they had for homeowners, now it's for businesses as well.
I think we went over that in the last one here. So let's see. We went over new law alert. No, I think it might have been a couple before that. This was the one in regards to manufactured or mobile homes.
Yeah.
I don't think we went over it in there.
Yeah. So a lot of consumer protection stuff launched this year. So maybe that's what we'll do our next podcast on. Deep diving into those 5 things, going over them and letting them know how it affects you and what you can do in order to kind of be ready for the year ahead.
Yeah, absolutely. We'll get that all together for next week.
Sounds like a deal. Sounds like a date.
Cool. Well, you want to end the stream now? We're
Yeah.
at,
Yeah, I don't see anyone else on there chatting or asking any questions, right?
nope.
Okay. Well, as always, thanks for your time, Chris.
Of course.
And we'll see you next week.
Sounds good.